Assalamualaikum warahmatullahi wabarakatuh. Good morning, everybody. This is the title of our presentation, Lognormal Distribution on Stochastic Dominance for Investment Management. This is the work has been done by myself. I'm Isnandar Slamet from the Department of Statistics, Universitas Sebelas Maret, and also my colleague, Muhammad Nur Abdul Aziz. He was with the Department of Mathematics, Universitas Sebelas Maret, and my colleague, Zukhronah from the Department of Statistics, Universitas Sebelas Maret. We start with introduction. Investors used to find out forming portfolio which is efficient portfolio, and in the same time correct time so that they can get the optimum profit in the future. For this, the investors has to consider risk and rate of return. And risk is defined as the uncertainty that causes the deviation from the expected return, and rate of return is the expected profits. At the same time, also investors need to find a method to select an investment in order to obtain the expected return. There are many criterions. One of the criterions is the stochastic dominant criterion, which is two mutual assets and stochastically in which one asset dominates the other. Is stochastically in which one asset dominates the other is preferred by investors. So there are three stochastic dominants: first order dominant, and the second order dominant, and the third order dominance. Chang, 2011, applied stochastic dominance criteria on the financial holding company bank by performing the comparison between the independent banks in Taiwan on daily data from 2003 till 2009. Slamet et al., 2016, has applied stochastic dominance criteria for analyzing calendar anomaly by performing comparison on daily and weekly returns on the Indonesia stock market. There are also people working in the same area like Slamet also has applied almost marginal condition of stochastic dominance. And Slamet 2018 has applied almost stochastic dominant criteria for data of expenditure per capita based on districts in Central Java. Ali, 1975, comparing between the principle of stochastic dominance with the mean variance criteria. And there are other people working in this area of stochastic dominance. So we applied stochastic dominant criteria for data which is assumed to follow log-normal distribution by considering the theorem and condition with its properties of log-normal distribution, and we applied the stochastic dominant by putting first stochastic dominant and second stochastic dominant. And we analyze for the data of stock price and the Indonesian stock market for data starting from March 2015 until February 2018. Now, we see the concept of utilities, stock dominance, and log normal because we will discuss in the presentation the application of stock dominant in the data which is log normal distribution. The utility function basically is a relative measure of company business income. Year 2001 defined stochastic dominant as the term that related between two distribution functions, whether a distribution function is more dominant than other distribution function. If there are two conditions, A and B, then B will be preferred over the condition A if and only if the utility expectation value of B higher or equal than expected value of the utility A. This is the mathematical expression of this uh, 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 two condition A and B, which is B will be preferred over the condition of A, and it is the mathematical expression. And for the first order stochastic dominant criteria, basically we derive this cumulative distribution fx minus gx greater than or equal to 0. It is when there is infestation B dominates A by first stochastic or dominance on utility function U1 if and only if this this expression is satisfied. And the second order stochastic domain basically is the integration of x ft dt minus gt dt greater than or equal to 0. And this is B dominant A in the second order stochastic dominant criteria. And the third one is the third order stochastic dominant criteria, which then this is the expression of the third order stochastic dominant criteria. Log normal distribution, according to Atkinson 1963, log normal distribution is continuous probability distribution of random variable with its logarithm is normally distributed. With this, uh, we can write like this: y equal to ln x, or x is the expectation of y, x a in the power of y, so that the notation can be given by fx equal to this expression. Hence, x is a log normal distribution. So the research methodology we uh, propose first is literature review, and the second is implementation of the criteria. In the literature review, include determination of the properties of the log normal distribution of the data, and then we continue to use the properties on the stochastic dominance criteria, and then specifying the condition, that is the against standard stochastic dominant criteria, which is log normal distribution. And the implementation of the criteria is first by collecting data, testing the normality test of the stochastic data, transforming stock data, conducting the normality test of stock data formulation, determining the price of shares that are in distributed log model, and sorting the stock price from the smallest to the largest, calculating the probability of each stock price, calculating the cumulative distribution function of each stock price, determining stock prices that dominate using stochastic dominance with log normal distribution, and determining of the dominating stock price and drawing conclusion. And this is the result of our research. Basically, stock prices cannot be negative, and many distribution of the return rates observed in the stock market are positively skewed. It is therefore log normal distribution is more economic justification. Levy give term one, let F and G be two distinct log normal distributions such that XF is normally distributed with mean of population mu F, and standard deviation of population is sigma F. Likewise, XG is log normal distribution with mu G and sigma G. Then F dominate G by first stochastic dominant if and only if this criteria is satisfied. And the theorem 2 basically is definition the theorem when F dominates G by second stochastic dominant order. So this is the criteria, so that we can say then F dominates G by SSG. We apply stochastic dominant criteria on monthly stock price data from March 2015 till February 2018. And if there are 4 companies, and then using Saviro normalities, we can say that LN for AD, LN for INCO, and LVICA, and LPPTN. And because of the p-value are greater than or equal to alpha 0.05, then the decision is not rejected. So that we can say that this data is normally distributed. The ln of the logarithmic natural of this data is normally distributed, so that we can say that log normally distributed is. We applied by using theorem 1 and 2. This is table 2, mean and standard deviation of each stock price. And the second, the theorem test for FSC of normally distributed by testing the mean and the variance of the two population, and FSD criteria are not satisfied based on this result. That we need to continue our test for the second order of stochastic dominant by using theorem 2. And by using the theorem 2, then for first stochastic dominant criteria, there is no dominant, oh sorry, this is a second order stochastic dominant, and we have this INCO dominates BPTN, VICA dominates BPTN. So table 3 shows that INCO and VICA dominate BPTN by first stochastic dominant. And we continue by calculating the values of expected value of X and expected value of G. And hence, we find the table 4. And from this table, we can say that not all values EF greater than or equal to 80. So the first condition is not fulfilled. And so we need to calculate the CF, CG. So CF less than or equal to CG. And from this, we can say that no dominant between AD and INCO by second order stochastic dominant. For a combination of other stock price, we can see from the table 5, and this by putting the SST criterion, we can say AD and INCO, there is no domination, there is no dominance with AD and VICA, and there is domination between AD and PPTN, and likewise INCO, PPTN, VICA, and PPTN also. So this table shows that AD, INCO, and VICA dominate PPTN by second order stochastic dominant. By checking the tests from theorem 1 and theorem 2 with classical tests, we can say that it is ID, INCO, and VICA dominates PPTN by SSD, while INCO and VICA is not dominated PPTN by FSD, such as on the test used theorem 1. The result of stock price data using standard stochastic dominant with Lognormal distribution can be present in the tables below. Table 6 shows that ID, INCO, and VICA have one domination, and BPTN has no dominance. Domination shows that the stock is preferred. So RD and INCO and VICA are preferred by investors rather than BPTN. So as the conclusion, we can say that log-normal distribution can be used for managing the return expectation under stochastic dominant criteria. This is our first conclusion. And the second one, the dominant stock price for our data is AD, INCO, and VICA, and there is no dominance for PPTN. Therefore, RD, INCO, and VICA are preferred by investors. Ladies and gentlemen, this is the references that we considered. Number 1, number 2, till number 10. Thank you very much for your attention. Assalamualaikum warahmatullahi wabarakatuh.